In last week's commentary, we referenced investors feeling the squeeze. This week, we're going to talk a little bit more about where that's coming from and how to navigate it. So when people take that hard-earned money that they've been working for, saving up, deflecting from a paycheck, whatever it would be, and put it to work, it's completely understandable that they would love to see progress right from the jump. Or at any point in time along the way, they want to feel like with the passing of each of those months on the calendar, they're chipping away, helping achieve those goals and dreams. Unfortunately, markets don't move in straight lines, anything but. Again, as we've said, markets don't work all the time, they work overtime. And so how do you get through those periods of volatility, that squeeze of feeling like you've made a mistake without doing what so many investors statistically do, which is feel compelled to do something and in that emotional state, make a decision that is going to be counterproductive to actually reaching your goals. We all know to buy low and sell high. It's much easier said than done, most notably because buying low means not chasing things when they're hot and in the newspaper, but instead buying or maintaining positions in things that are out of favor, that don't feel smart, that don't have a great track record you can look back on online in the recent past. And yet that is the path forward that we want to help people navigate. So where are we at today? What is the environment? That first squeeze, to reiterate, is really just the macro environment itself. The storm clouds are darkening. They can pass, but they're getting darker on the horizon. And really from two big factors. As Tom Essay put this week, the two biggest risks to the current equity market rally are that inflation bounces back and that growth slows too much. The latter, that growth is beginning to roll over. And the biggest driver of that is the American consumer feels about tapped out. You had a survey from Bloomberg come out this week that showed almost 70% of the respondents felt the consumer would be tapped out either in Q4 of this year or early 2024. For those trying to say, but didn't the Q3 data come in strong, or isn't it coming in strong? And it is. Anna Wong, a chief economist at Bloomberg, had this to say: the current growth is not sustainable because it is driven by one-off factors, most notably a summer splurge on blockbuster movies and concert tours. Yes, Taylor Swift has helped delay the U.S. recession. Secondly, the San Francisco Fed came out this week and stated that, the extra savings on balance sheets is dwindling down to about nothing. And that, again, consumer that's already feeling the strain of inflation on their budget, higher rents, higher credit card interest, is now about out of all that COVID cash that got splashed around a few years ago. On the inflation front, there again, things likely won't be easing either. Inflation, again, is a relative number. That's important to say. It's always compared to where it was at some other point in time. And in this case, oil, troubling as it is in general at $90 to $100 a barrel, is going to have a much negative influence in Q4, much more negative influence than it did in Q3. Last month, commodities in general helped push down that inflation gauge on an individual level, not a total level, by about 4.2% year over year. As Daryl Jones of Hedgeye noted this week, moving into Q4, those year over year comps are much different, and oil will add just singularly within its factor, inflation being a multi-factor number, a plus 18% handle approximately. So inflation's getting sticky. Fed likely has got to raise one more time, as Neel Kashkari, a Fed governor, came out and stated this week, at least just this year, all of which adds up to that dreaded stagflation term, high inflation, slow growth, and that's why you've seen the market selling off. In the face of this and what's working, you've got what this next chart that'll come up here on the screen momentarily shows, which is a very bifurcated market. We're in a year where bonds are flat, real estate's slightly down, value stocks kind of middling along. You've had basically 7 stocks leading the overall indice higher, big gap, almost a double gap in price earnings ratio between growth to value stocks, all of which, again, leaves investors, particularly impatient investors, in a very precarious spot. Do we chase the so-called winners? Are they the only path to success? Or do we stay with those things trading slightly out of favor, relative good valuations. We, of course, for most investors, would strongly recommend buying low. Again, is about being patient, understanding bottoms are processes, not points, and where can you get good cash flowing investments to help you continue to make progress over time. So finally, bonds, are they broke or are they beckoning? This is definitely an area where people are feeling the squeeze, but an area that we think people should reflect with their professional. Is this something where we should be beginning to add to positions, creating positions if they don't already exist? This chart that'll come up from the Hartford here momentarily shows you, yes, bonds have had a year or two of weakness in the past. Historically, after that comes real periods of strength. You're seeing attractive yields, but the question is for people when they look at money markets with nice attractive yields themselves, well, why add that duration? Why put myself through the squeeze? That's what these next two charts from AllianceBernstein we're gonna share. The first one really just shows that, hey, these yields aren't forever. Number one, they're barely outpacing inflation, so your real return is slim to none. Yes, that feels comfortable. Yes, it's a flat-lined return. But as the Fed eventually cuts rates, so too are those rates going to come back down at or below an inflation level, which means your actual purchasing power is being eroded. Conversely, if you look at the next chart from AllianceBernstein, it's what a basket of different fixed income sectors have done after the Fed began cutting rates. And here's where you can see duration, that interest rate sensitivity, the length of the debt, that can be a headwind when rates are going up, can become a very powerful tailwind once they begin to come down. Which of these are right for you? Of course, is a conversation for you to have with someone who's knowledgeable in this area. The point here is, again, as safe and comfortable as cash can feel right now, there's some real alternatives that at least most people should consider as part of their financial plan. In summary, again, markets do not work all the time, they work over time. And what that means, again, is you're not going to see things move in that kind of straight line, constant progress you see. What happens is you step back over those 3, 5, 10-year time frames, those averages that you've come to expect finally come into view. But that doesn't happen unless you, A, have the courage and patience to buy low, to hold tight to those things that might be meandering through, and again, resist the urge to buy those hot things. We can all look back over time to stocks, certain cryptos, whatever the case may be, that had all the headlines, had all the attention, and chased all sorts of people into them all at the wrong moment. And our hope for you is that will not be you, but instead that you'll find that right allocation that you can sleep with, but that can still help you achieve your goals and dreams. Thanks for watching. See you next week.